Okay, we will begin our exercises for Chapter 14, Financial Statement Analysis. The very first one we have is number 1, and it's entitled Vertical Analysis. So we've got a bunch of accounts here, and it says prepare an income statement in comparative form, and then state each item for both years as a percent of sales. So vertical, up and down, and everything is as a percentage of sales. So of course then we're going to put sales at 100%, and then everything drives from sales. So in this case we have both years presented, 2 columns, and we calculated everything as a percent of sales. So for instance, if you needed to calculate net income as a percent of sales, you take 360 divided by the 4 million up here on top, and you would get 9%. So from a vertical standpoint, you can compare one year to the next based on those percentages. Number 3 is another financial statement here. It says common size, revenue and expense data for the current calendar year for this company and for the electronics industry are as follows. All right. Prepare a common size income statement comparing the results of operations. So common size, again, we're looking at a vertical analysis here, and we have the average put in the third column, and then we just put in our data in this first column, and we calculate as a percent of sales. Again, sales always being 100%, and this way what we can do now is compare how are we doing to industry, and it's another helpful tool. Number 4, again, a vertical analysis of the balance sheet. Again, in this case, you put in all the data, but what's important is the total assets, or in this case then also the total liabilities and stockholders' equity needs to be 100%. So everything drives off of total assets. So current assets, 2.5 million as a percentage of 10 million is our 25%. And what we're doing here now is comparing from one year to the next how our current assets are calculated as a percent of total assets. Number 5 is the first time now we're looking at horizontal. So what we do here in this case is we put all our information in as presented in our exercise, and then what we're doing is taking the difference between the current year and the previous year and getting an increase or a decrease, and then we take that amount and we calculate the percent of increase or decrease. So what you have to remember in this situation is, what is the denominator? So we know that the numerator is 240, but you got to be able to calculate the correct denominator, and it's always going to be that base year or the oldest year, because what we're trying to do is calculate what's the change going from 2 million to 2.24 million. So we take our 240 divided by 2 million, the base year, the starting year, and we get our percentage of change. That's an important fact. Make sure you don't use the wrong denominator. You have to figure out what are you changing from, so your base year. All right, moving on now to some of our ratios. Number 6, in this problem it says here, determine for each year the working capital, current ratio, and the quick ratio. And in this video, I'll probably always do just one of the years, knowing that it's exactly the same for the next year. So working capital is simply just taking current assets, 2,090,000, minus current liabilities, 1,090,000. So in the current year, you're looking at 1,090,000. All right. Current ratio is current assets divided by current liabilities. And looking at this solution, you should cross this off, because that actually is the definition for quick assets. Current assets, as listed in your text, is all of those, cash, marketable securities, AR, plus inventory and prepaids. $2,090,000, so they have the number right. $2,090,000 divided by our current liabilities, $1 million. Quick assets are just those three: the cash, marketable securities, and AR divided by current liabilities. So the current liabilities number stays the same, but that quick assets are just those first three. Number 9 is asking to calculate AR turnover, and the definition is sales divided by our average AR. And in the text, they tell you what the sales are: $5,637,500 divided by average AR. So how is average AR calculated? Take the current year, 725, plus last year, 650, and divide it by 2. That is our average, and we calculate 8.2. 8.2, looking at it from last year, it was 7.5. It means we are improving. We are turning our AR faster, more often. Number 11, looking now at inventory turnover. Inventory turnover. Actually, I skipped something with number 9, so I'm going to back up here. Number of day sales in receivables. So again, we'll take that average, which we just calculated, 687,500, divided by the average daily sales. So you take your total sales number, and in this case it was 5,637,500 divided by 365 days, and we get an average of 15,445. So the number of days sales sitting in AR, calculate for this year, is 44.5. Last year, 48.7. Less days sales. That's good, and it makes sense because we're turning them over faster. Number 11, again, back to inventory. Inventory turnover, we take our cost of goods sold. They provide us that number, 9,270,000, divided by the average inventory, and they give you beginning and ending inventory for each year. So we divide that by 2. Our inventory turnover is 9 as compared to last year, 12. Number of days sales in inventory, we take that average inventory again, which we just calculated right here, and we divide that by the average daily cost of goods sold. And they provide that number as well, 9,270,000, divided by 365 days is 25,397. So the number of days sales sitting in inventory, 40.6 as compared to 30.4. So is that concerning? It depends on what kind of industry you're in. You know, it's growing. Having your capital tied up in inventory is costly. You know, if you're selling milk, obviously an extra 10 days is bad news. You're selling cars, 10 days is probably not as worrisome. 10 days is a lot though. So we have a lot of sales sitting in inventory. That's something we probably would want to address. All right, let's look over number 13. Number 13. It says here, ratio of liabilities to stockholders' equity. All right, so total liabilities, which would be the summation of AP, the current maturities, and the serial bonds. Okay, 2,124,000 divided by total stockholders' equity, which would be the last three, 250, 1,250,000, and 860. And our ratio is 0.9. 0.9, almost 1-to-1, just as much debt as there is equity. All right, it's improved from the last year because now we're down to 0.9 and it was 1-1. Times interest earned is income, And in this case, they tell us it was $480 plus interest expense. So we're adding that back. Well, if you look in the text, this is what everyone misses. There's not only the serial bonds at 10%, but you also have the current maturity of that serial bond. So we actually have 1.2 million in bonds. 1.2 million times 10% is 120 grand. So our numerator in this case is the 480 plus the 120 divided by our interest expense calculates to 5. So the question is, times interest earned. How many times can the bank earn their interest based upon our net income? Well, this year, 5 times. You only pay it once, but we could have paid it 5 times. Last year, we only needed to pay it once, but we could have paid it 4 times. Number 15, ratio of liabilities to stockholders' equity. So in this case, we look at our total liabilities, which would be the current liabilities of $14 million, the long-term liabilities of $13 million, and then other of $8.67 million. So there is our total liabilities divided by our total stockholders' equity of $25,215,000. We calculate it to be 1.4. These ratios are quite straightforward. 9 times out of 10, it's exactly the numerator and the denominator based on the title of the ratio. What is the ratio of liabilities to stockholders' equity? We look at all of the liabilities to all of the stockholders' equity. Now it's the ratio of fixed assets to long-term liabilities. So property, plant, and equipment, 8.229 divided by, and it says here, long-term liabilities. So what is our long-term liabilities? Well, we have 13 million and 8.6 million, not the current. So just those two, the 13 and the 8. So we're looking at 21.906. And in this case, it calculates to 0.4. Number 16, it's asking to calculate the asset turnover. And it's simply, let's just do it for this YRC worldwide. It is the sales of 4.697 million divided by average total assets. So they give us that number, 1.8 million. So what's our asset turnover? 2.4 million, or excuse me, 2.6, excuse me, is the calculated number for the asset turnover for the first company. Number 17, it asks us to calculate profitability ratios. Profitability ratios. Well, there's 3 of them that they want us to calculate. Determine the return on total assets, return on equity, and return on common stockholders' equity. So first, net income plus interest expense. They give us the net income of $372,000, and then let's calculate the interest expense. And in this case, if you look at notes payable, 2.25 million times 8% is 180 grand. So our numerator, 372 plus 180, divided by our average total assets. And in this case, you got to take your 4.8 plus the 4.4, divided by 2, and you get 4.6. So our return, 12%. Return on equity, again, net income, 372,000 divided by the average equity, So in year 20Y7, you would add the 250 plus the 500 and the 1574, that number, and then looking at the next year, 06, 250 plus 500 plus 1222, and then the sum of those two of 07 and 06 divided by 2 will give you 2.148 right here, 2.148, which is 17.3%. So our return on assets is going down. Our return on stockholders' equity is going down. Return on common stockholders' equity. So now we take our net income, less the preferred dividends. And if you look at our preferred dividends, there's $500,000 sitting in the preferred stock line. Take that times the 4%, and they're going to get 20 grand. So now we're down to 352 divided by the average common equity. Now let's make that clear. The average common equity would be 250 plus the 1574 only for 07. And then comparing that to 06 of 250 plus the 1222. Taking the 07 number and the 06 number and divide that by 2, you get 1648. And again, our return is 21.4, and it is decreasing, not what we'd like to see. Number 21, our last exercise is calculating earnings per share, price earnings ratio, dividend yield, and dividends per share. So first one, earnings per share, net income, and they give it to us of $1,750,000, less the preferred dividends, which is, how do we calculate the preferred dividends? Well, there is $2.5 million in the preferred stock line, 2.5, divide that by the par, and that'll, by 40 bucks, that tells us we have 62,500 shares. 62,500 shares times their $4 rate, they earn $250,000. So our net income less the preferred dividends of $250 divided by the number of shares outstanding for common. Again, they don't give us that number, so you take your 10 million divided by the par, tells us there are 500,000 shares. So our earnings per share is $3. Earnings per share typically is calculated for the common stock only. Price earnings ratio, the book gives you that the market price is 45 bucks. You divide that by the earnings per share for common stock, which is right there. It is 15. That's our price earnings ratio. Common dividends, and in this case, the book tells you the dividends declared for common stock were 1,125,000. We just calculated the shares outstanding for common, 500,000 shares, 2.25. The dividend yield, again, takes that 2.25 and it divides it by what the book provided for you, the market price, 45 bucks. Our dividend yield is 5%. All these ratios are great to calculate. They give you a lot of information, but it's only as good as when you can compare them from one year to the next, so you can see a trend. Are we going in the right direction? Are we holding flat? Or are we decreasing? So ratios are good for calculating, but unless you've got some historical context, you can't really determine if we're moving in the right direction. The last few problems, so problem 1A asks you to calculate horizontal. So once again, this is no different than the first couple of exercises. You look at current year, prior year, calculate the difference and divide it by the prior year, and you get your increase or decrease. Okay. Problem number 2A is looking at vertical analysis. Again, everything as a percentage of sales, 100%. And we calculate, so for instance, income before income tax, 600,000 as a percent of 1.5 million is 40%. So we're calculating it for both years. And then the last problem, and we won't calculate all of this because these are exactly the same problems or exercises that we did. 1, 3, 4, 5, 6, 9, 11, 13, 15, 16, 17, and 21 are all right there. So we're calculating, and they give you what the numerator is and what the denominator is for each of these, asking for in problem 4A, which starts on page 737. So they not only give you a retained earnings statement, they give you an income statement, a balance sheet, and it's a classified balance sheet, so you know exactly if you're looking at current liabilities or all liabilities. And then the instructions ask you to calculate all of the ratios for this problem 1 through 18. And like I said, those are exactly the same that we did in the previous exercises. Chapter 14 is pretty straightforward. Quick chapter. Make sure you understand the numerator and the denominator. Read the chapter so you know what these ratios tell you. What is the point in those ratios? Is it good to have a higher number, a lower number? In relation to previous years, are we going in the right direction, in the wrong direction? So make sure you take the time to read the chapter. That takes care of chapter 14.